So tonight we're going to be talking about blockchain. It's a topic that's absolutely fascinating and wonderful and amazing. And when you talk to people, they also say it's absolutely wonderful and fascinating and amazing. And when you ask them what it is, they might say, oh, it's a distributed ledger. And you say, yeah, and what else is it? And once it gets a little bit deeper than that, it's actually very difficult to decipher oftentimes. And so tonight's presentation is really for everybody, whether you've had experience with blockchain or not. And we're going to be starting from the very basics of really what money is and what monetary value is, etc. And we'll build it up from there. We'll keep the questions to the end, so if you do have any questions, please write them down, and then we'll be happy to take them. So to start off with, the question is, how do we agree on who has monetary value in our society? We have dollar bills or rands, we have gold coins, we have shells. Back in the day we had salt. All of these things are what we call bearer instruments. They were in physical form. The holder is presumed to be the owner, and there's no record of who had these bearer instruments before you had them. So the 100 rands that's in your pocket, nobody has a record of where that 100 rands was before it was in your pocket. We just say whoever has it is the presumed owner. Now, that's juxtaposed against what we call registered instruments. And here we have things like property, we have cars, we have cell phone minutes, equities and bonds. And here, as a society, we have said that these are assets that are either in physical or digital form. There is a record of ownership, and as a society, we have assigned trusted institutions to govern those registers and to update them on our behalf. And we all look to those institutions as having the source of truth for who owns what. So if someone's in a car, it's not a bearer instrument. You can't just steal a car and sit in it and say it's mine because I'm in it. It's a source of truth, and we know who that actually belongs to. So this is an important point because really in society we only have bearer instruments and registered instruments. So there are only two ways that we assign value to people in our society. So how do we transfer monetary value once we know who has what? So if I have a physical bearer instrument, it's easy. I've got a gold coin, I give it to you. Nobody ever asks, hey, has my coin cleared and settled yet? Right? It's just given and it's done. The trade is done. We're not waiting for any ledgers to be updated. However, if we buy or sell a house, buy or sell a car, or buy or sell a certificate of ownership of a share or a bond, we have these trusted institutions, again, that hold the ledger. And that's why when we do these things and buy these assets, it takes us anywhere from maybe 3 days all the way up to several weeks or months for that transfer to actually go through. And that process is what we call clearing. Okay? It's where instructions are being sent for ledgers to be updated, and once those ledgers are updated, that's called settlement for the non-finance or bankers in the room. Okay, so what we call money now straddles both of these things. Okay, we have, again, a dollar bill or a rand. This is a physical bearer instrument. And now when we go to the bank and deposit it in the bank, that very act of depositing it in the bank transforms that value from a physical bearer instrument into a digital registered instrument. And so the only reason you have that value is because the bank says you do. If for whatever reason the bank's systems went down or they had a dispute with you and they said that you no longer have that 100 rand, you don't have the 100 rand according to society. You could fight it in a court of law, but you would still need to effectively influence or convince people that there was a mistake in the ledger. All right. So again, with money, if I have the rand or the dollar and I give it to somebody and it's a physical bearer instrument, there's no clearing and settlement. It's just traded immediately. Now, we're very, very fancy, or we think we're very fancy in society, where we get on our cell phones, we get on our mobile apps, and we say, I'm going to send you electronic money. And we all think that we're just sending electronic money. But we're actually not sending anything of value. What we're actually doing is sending a series of instructions from our channel or our phone or our internet connection to our bank. And we're basically telling them to update the ledger and say, hey, I'm going to send some money to this guy over there. So they, in turn, will then send another message to the central bank. Another message is then, in turn, sent to the other bank. And finally, there's a message that goes back to the person over there that says, your money has arrived. So what we have here is several trusted intermediaries, in this case at least 3, whose ledgers need to be updated. And that's why when you send money to somebody that's at a different bank, it often takes a day or 2 to get there. If you send someone money from the same bank, it generally is pretty instantaneous. So, until 2009, no one had ever transferred money, or value I should say, digitally from one person to another without a trusted intermediary. This is very, very important. So I'm going to say that again. Till 2009, no one had ever transferred value digitally from one person to another without a trusted intermediary. Physically, yes. Digitally, no. Why? To discuss this, we need to talk about this concept called double spending. Now, if someone doesn't know what double spending is, they don't really know what blockchain is. So, we need to look back at the history of computer protocols. A lot of these acronyms you will recognize: TCP/IP, HTTP, SMS, SMTP, etc. All of these are computer protocols that are absolutely fantastic for digital communication. This is what makes our society so rich and so efficient when it comes to communication. But these very protocols are absolutely horrible for digital value transfer. Now let me explain that. I've got my phone, and I've got a nice little picture on my phone. And see Martine in the crowd. So Martine has her phone over there, and she wants the same picture as mine. And so I say, no problem, Martine. I'll send it to you. And I do send it to her. And she receives it. And it's a whole bunch of ones and zeros, which is really at the basis what something digital is. It's made up of ones and zeros. She receives that picture, but guess what? I retain a copy of it on my instrument or my device. Fantastic for communication, but what's critically important for digital value transfer, or any value transfer, is when someone is credited with something, someone else is debited. Otherwise, you have an inflating monetary base, and soon enough people say, wait a minute, I mean, this is as good as leaves. And when there's so much, and there's a lack of scarcity in a monetary resource, its value drops and it no longer functions as an instrument to carry value. So anything digital has this digital fingerprint of ones and zeros. And again, if there was some type of representation of a digital asset that was just ones and zeros, just as I can copy and paste an email over and over again and send it to tons of people, I could do that with anything that represented value. So you can see right there it doesn't work so well. So as an example, let's say I have a coin. It's got a digital value or digital ID, let's say, of 1101. Again, it's just physically represented here, but it's just 1101 that lives on a server somewhere or in a computer. And that one coin could, let's say, buy some eggs, or it could buy some milk, but not both. If I wanted both, I would need 2 digital coins, but I only have 1. Or let's say Abongile, our friend over here, has 1. Now, Abongile could double spend her one single digital coin by sending it to 2 people at the same time, taking the value of eggs and of milk before the people on either end realize, well, wait a minute, who has 1101? Do you have it? Do I have it? Oh, no. And already there, we realize that there's been some double spending or some fraud. And so this ability to double spend reintroduces the necessity of having a trusted intermediary to make sure that when someone is credited, someone is debited. That's effectively what our banks do for us as a society. Now, what happened in 2009? So Bitcoin happened. Now let's talk a little bit about that. This is not a Bitcoin talk, so I'll just say a few words about this. In 2009, or 2008 actually, there was an individual called Satoshi Nakamoto. We don't know who he, she, they were. It's a pseudonym. They wrote a paper called the Bitcoin and Peer-to-Peer Electronic Cash System. If you have not read that paper, I would highly encourage you to read the first 2 to 3 paragraphs only. Because, well, let me say not only, at least I should say. And the reason I say that is because Bitcoin has got this connotation of being associated with drugs and like illegal things. And really, when you go back to the source of this, the idea of what Satoshi Nakamoto was saying is, listen, we're in a pretty advanced society. If I want to send value to someone digitally, why do I need to go through a trusted intermediary and pay their fees? That's ridiculous. It's crazy. So I want to be a bit more free in society, be able to send someone value digitally. We have all these protocols, but without an intermediary. So what he wrote in 2008 was actually put into a network, or it was manifested in a network in 2009. And in 2010, the first Bitcoins were traded. Someone sold 2 Papa John's pizzas for 10,000 Bitcoins. At the time, they had no value. Those 2 pizzas, if you looked at that 10,000 Bitcoin today, is worth about 100 million rand. So someone selling 2 pizzas, what is it? That was 6 years ago, is worth, well, if they kept the Bitcoins, would be worth 100 million. We'll talk about value and tokens a little bit later on if we have time, but there's a very, very distinct difference between a token that represents value and what the value is of itself. The value is determined by the market. The token is issued by let's say, a central authority like the Rand or the central bank. All right, so to go forward, because I'm going to explain this to you a little bit, we need to go back in time about 1,500 years to an island called Yap Island in Micronesia. Some of you may recognize this. Does anybody recognize it? No? Okay. So this is what's called a rhinestone. And a rhinestone is actually a limestone disc. And that ranged in size from, say, 30 centimeters all the way up to about 3 to 4 meters. This was the currency of the villagers on this Yap Island. What they did was, on Yap Island, there were actually no limestone deposits. So as a society, they agreed, whoever has or gets these limestone deposits from a neighboring island, and I'll explain that in a second, they've mined some value, and that the society agrees that there's some type of value there. So just down the stream, or the ocean, from Yap Island was another island called Palau, as I mentioned. There were limestone deposits there. So what people did from Yap Island was they got onto their bamboo boats, or their rafts, and they went down to Palau. They excavated these limestone discs, put a hole in them, put a pole into them, took them back onto their bamboo floats, their rafts, and went back to Yap Island. And then they would put it on the village square for people to see. And they would effectively say, guys, I've just gone and mined this. Here it is. Mine is the big one with the marks, and check out those marks. Okay? The villagers in the island would then all talk amongst each other and say, hey, did you hear what Farzam did? He brought this huge rhinestone, and it's so cool, and it has these amazing marks in it, etc. And they would all talk amongst each other, and it would filter through the village that I have just bought this rhinestone. So, a couple of things here. As you would probably agree, this is a pretty horrible bearer instrument. Right? If I wanted to buy some coconuts from the guy down the path, and I took a couple of coconuts and said, just wait a second, let me just try to roll this to you, that wouldn't work so well. It's a pretty efficient monetary instrument. And at the same time, there was no village chief or central authority that kept a register of these stones. And so this wasn't a registered instrument either. So it was strange. What was it? So basically what would happen is, if I wanted to spend my rhinestone for those coconuts, I would tell the villagers, and I'd say, hey everybody, you know this is my rhinestone because I came and I showed off about it when I brought it here. And now I want to give it to Claire. And they would all say, okay, everybody, is this Farzam's rice stone? Yes, it is. Has he tried to give it to anybody else? No. Okay, cool, it's Claire's. Everybody happy? Yes, we're happy? Okay, it's Claire's. Done. Now, if the next day I came, I wanted to buy some mangoes, and I said, hey guys, I'd like to buy some mangoes, and by the way, remember that stone of mine? I'm going to give it to John. And they'd be like, no, wait a minute. You already spent that yesterday, and it's Claire's. We don't recognize that, and you can't do that. So they, as a community, stopped double spending, just by talking amongst one another. Now, there are a couple of interesting things about this. There's a story that one of these guys had this rice stone on the raft, or a few of them. As they were coming, they were coming back to the island of Yap. There was this huge storm that basically toppled over the bamboo raft, and the rice stone fell to the bottom of the ocean. These guys were able to survive the storm. They got back to Yap Island, and they said, hey guys, it was this huge storm. We had this huge stone, but it's right at the bottom of the ocean. And people said, wait, was it really there? And they said, yes, it was. And so the village continued to transact that stone as currency, even though it was at the bottom of the ocean floor and it wasn't visible. So this idea of abstraction also now comes into the picture, which is really what our money is in society in general. And the other thing is that how do they keep track of who had what stone? And apparently they kept songs of how the ownership of stones transferred from one person to another. So effectively, schematically, the person at the top and the person who wants to spend that stone to the person at the bottom. There's a whole bunch of villagers. The person at the top tells these people that, hey, I'd like to spend this stone and give it to somebody else. They all confer, and they agree, yes, it's the person at the top. They haven't tried to double spend it, and the transaction goes through. Now, a couple of things about this system. Ownership needs to be crystal clear to every single person in that community. Otherwise, the system doesn't work. Secondly, the physical asset doesn't need to be visible. It can be at the bottom of the ocean, so long as society agrees on a finite resource that's supposed to represent some type of value. There was also no chief, as I said, or registrar, so to speak. So this was not a registered instrument. And there was a chain of transactions that the villagers kept through their songs. So back to 2009 now, 1,500 years later. If we substitute this rice stone for something that we call Bitcoin, and we say that that Bitcoin is limited in value, limited in issuance, so there's a limited issue, it's a scarce resource, and we change those villagers to computers, we effectively have the Bitcoin network. And it works in pretty much exactly the same way as those villagers worked in Yap Island 1,500 years before. Because what happens is every 10 minutes, if someone wants to spend a Bitcoin and send it to somebody else, they need to propagate that transaction through the Bitcoin network. There are a whole bunch of, let's call them computers. You'll hear them referred to as nodes. There are lots of different types of nodes. There are miners and other nodes called SPVs, etc. We can talk about that if we have time, but for the purposes of right now, let's suffice it to say that there are computers that process these transactions. As we talked a few slides earlier, the beautiful computer protocols that came about in the information age from the 70s onwards allow these computers to confer much, much quicker than those islanders were able to confer back in the day. And so you can verify a transaction much, much quicker. And coincidentally, the protocol that is used in Bitcoin for these computers to speak to one another is called the gossip protocol. So they're gossiping amongst each other to say, hey, has there been any double spend? If there has, no, we don't accept this transaction. If there hasn't, then it can. These computers, without going into the details again, are incentivized to be a part of the network, or at least some of them that are involved with mining. And they're incentivized by actually getting a reward of Bitcoin. So that's why they actually contribute to this network. And lastly, there is a chain of transactions on a blockchain which is what the Bitcoin network was the first illustration of. And every single Bitcoin that's in existence, there's about 15.7 million Bitcoins today that's in existence, and there will be 21 million, but there will be a cap of 21 million. Every single Bitcoin you can trace back till the time it was issued into the system. So that has huge ramifications also for us as a society, anti-money laundering when it comes to banking. And so effectively it's like you having that 100 rands in your pocket again, but there is a record of where it's been before. Okay, so why stop at Bitcoin? Why not any digital asset? And this is where I really like everybody to understand the very difference between Bitcoin and blockchain. Blockchain is that protocol or the technology that is used by those different computers to speak and to confer and to make sure that there isn't any double spending. Bitcoin, while it was the first asset to use this technology, is an asset on top of that protocol. And what we're seeing more and more in the world is that there are many other assets and protocols that use this technology, but are not Bitcoin. So that's a very big distinction, Bitcoin versus blockchain. All right, so equities and bonds, property, cars, derivatives, all of these things can now, or in the future, we're not there yet, they will be able to be issued onto some type of a blockchain. And imagine the ability of transacting your house, buying or selling a house, and it being transferred into your name in a matter of not weeks or months, but a matter of seconds or minutes. To me, this is not some crazy, unbelievable theory. This will be reality in the not too distant future. In my mind, there is no question this will happen. It's just a matter of time. Okay, so let's go a little bit deeper. I want to tell you a few concepts, just because I've got a few minutes left. I'd like to make you familiar with some of the concepts, and you can go and research these a little bit more if you'd like. Public and private keys. So the blockchain is really a beautiful combination of several different technologies. We've got some computer science that's there, and we've got some cryptology that effectively makes the system work. Why we say public and private keys? Let me give you an example. The credit cards that most of you have in your pocket right now, they effectively have a single key on them, which is your credit card number. And effectively, whenever you pay someone with your credit card, what you're telling them is effectively, if you use an analogy, hey buddy, this is the key to my house. Go into my house, I won't be there, but please go and take 100 rands that I owe you. Please don't touch anything else, don't take anything else. When you leave the house, can you please close the door behind you? Please lock it. Please don't copy the key. Please don't lose the key. And keep it safe for me. I really, really appreciate that. And we laugh, but that's exactly what our system is right now. And I was listening to someone in New York recently from Visa, and they said exactly the same thing. So it's not just me. It's Visa as well. So public and private keys in blockchain work a little bit like a post box, where you don't really care if everybody knows where your address is. It's P.O. Box 123 at Benmore Gardens. You can propagate that to the entire world. Who cares? So long as you and only you have the private key to open that post box. That's what the blockchain is. That's what the technology is like. So it's much more advanced and secure as well. Consensus, I think what's important here is that those computers, when they speak to one another, they need to have a protocol or some agreement or some methodology as to how to agree whether there is a transaction that's valid or not. So for instance, if you go back to those villagers, and I have a friend of mine and I'm trying to double spend one of my coins, and I tell my friend, hey, please, can you convince everybody else that I actually didn't double spend that? The rest of the villagers need to be able to say, no, actually, this node or this person is corrupt. We don't listen to that person's opinion. And as a network with a majority, we agree to what a valid transaction is. So that's the consensus protocol. Now there are lots of different types. The main one is what's called proof of work. And it requires people to do immense amounts of computer, and you probably would have heard about it as solving a cryptographic puzzle. Again, if we have time, we'll go into that. But it's effectively just a way to show people that you have done some work in the system and you have the right to include the next set of transactions into this blockchain. Proof of stake is another one. Another thing in this area is what's called public versus private blockchains. We're seeing that that differential or that difference coming a lot out in the world right now. A public blockchain is something like Bitcoin, or you may have heard of Ethereum, or something like Lisk. There are actually over 700 cryptocurrencies right now in existence. So there are tons of these things. A private blockchain is a blockchain where those computers, not anybody can come onto that network. Only a few pre-vetted individuals or computers or institutions can come together and create that. And that has big ramifications, again, for our financial system. And lastly, issuance. People think blockchain is this amazing solution for everything. If something is on the blockchain, it needs to get there. So when I talk about our homes, for instance, being able to transact it in a matter of seconds, selling and buying, there will have to be a process where all the properties in the country get registered on this blockchain. You can't just, it's not just magical, right? It's logical. So it will take some time for this to happen. All right, so to recap this part, in 2009, the digital bearer instrument was born. We had physical bearer instruments back in the day, which was the gold coins that we talked about. As society came together, we decided to have trusted institutions to hold ledgers that would really be the source of truth for who has what. And we had those for different assets. As we moved into the information age in the last few decades, those registers moved from physical registers to digital registers. And then finally, we have a digital bearer instrument, which is like a Bitcoin. And the reason I say digital bearer is because the owner of that private key, that I gave the example, the analogy of the key to the PO box, is the owner to the underlying asset in that box. If that key gets compromised, if it gets stolen, just like a key in real life, then the assets at that particular address will also be compromised. And that's why we call it a digital bearer instrument. So effectively, what the blockchain has solved is this double spending problem. And it's important to know that this isn't something that's just happened. As humanity, as society, we've been trying to solve this problem for several decades. It's just only recently that we've been able to combine these technologies to solve this ability of limiting someone double spending something that's digital. Okay, couple of things very quickly. Blockchain provides some things, not all things. It's a distributed ledger. It has instant and direct settlement, i.e. we don't have to wait for several weeks for our house to transfer. It can happen instantaneously. There's a huge amount of cost reduction from the people that are involved in that system, as well as the technologies and the systems that are used. And there's also no single point of failure. So there are, right now, as we speak, about 6,500 of these computers or nodes globally that help process the Bitcoin blockchain. Now, you can juxtapose that against banks that have maybe a server with all the data, and they have a few disaster recovery sites. That's it. They don't have more than that. So there's no single point of failure. But blockchain is not everything. So blockchain, although it can, and it probably will in the future, right now, it is not optimized for price discovery. And what I mean by that is, before you make a trade of a Bitcoin, the blockchain doesn't tell you what a Bitcoin is worth. People tell you what a Bitcoin is worth, right? You have buyers and sellers that come together in a marketplace or an exchange. And that interaction between buyers and sellers determines what the value is. And because there are not that many yet, although it's growing, you have a lot of volatility in the price. But it's not price discovery. For the bankers in the room or the people in finance, it doesn't mitigate credit risk, nor does it mitigate any legal risk. So, last couple of slides is what are the implications for banking specifically? So if we think about what banking is, it's actually very, very simple. So bankers are in the value business. We transfer that value, whether it's rands or Kruger rands, etc., or if it's bonds, equities. We store value for people, again, whether it's deposits. We provide value, whether it's through equity or through debt, a loan or an investment. And we protect value, whether it's through insurance or derivatives or things like that. Or we may advise on these 4 different pillars. But banking is no more and no less than this. It's quite simple. The blockchain has the ability to really disrupt two areas of banking in a big way. Payments or value transfer, and storage of the deposits. Payments, globally as an industry of banks, there was about $1.7 trillion that was received in revenue from banks. That represented 40% of total banking revenue. Now, when I want to pay someone in another country and I need to go through the banking system, say I wanted to send £1,000,000 rands, and I wanted to send it to New York. First of all, it would probably take about 2 or 3 days, if it's not the weekend. If it's the weekend and there are public holidays, maybe more than that. And if I've got a really nice bank, and they give me a really good deal, I might be lucky to pay 500 rand or 1,000 rand at best to send £1,000,000 rand to the US, right? So right now, using Bitcoin, if one wanted to, one could transfer that value, that monetary value. It would arrive in the US within 10 minutes, 20 minutes, maybe an hour at most. And it would probably cost me a grand total of maybe 5, maybe 6 rands. So when you think about what humanity can already do, and by the way, when it goes there, it doesn't touch a single financial institution. So this is a big threat to financial institutions in a big way as well. Because that $1.7 trillion, if people are saying, well, I can do it in another way, why should I pay this? Banks need to start thinking creatively about how they can actually improve services to their customers. So this is a great opportunity for banks as well, because it will bring costs drastically down, but it can be a great threat, as we just talked about. So the last slide is I just want to paint a little picture of what it may look like in the future. We have, let's say, 4 banks in our system, and as we talked about, there's a clearing and settlement process whenever we want to share or send money from one bank to another, or a bond, or an equity. But you can imagine a world where actually that clearing and settlement process no longer takes place, and people use a blockchain, or these banks use a blockchain to actually communicate with one another, like the villagers. Now, as a retail customer or as a corporate customer, I don't really care what you do, Mr. Bank. Just get my money from here to there, get it done quickly, and get it done cheaply. So there could be an argument to say, actually, your end customer doesn't really care what technology you use. You just need to provide the service well. Now, you could also, in this ecosystem, have other entities that could potentially come onto a blockchain. So asset managers or insurance companies that may not be banks. But for those of you that are familiar with SWIFT, that we think of as a communication network for banks, we also know that there are large corporations, Eskom, Sasol, etc., that are on the SWIFT network. And we could see something similar in a new blockchain world. And lastly, the central bank could actually be on the blockchain and in real time see all the transactions that are happening in the economy. There's a lot more that they can do. We don't have time for that today. But from a regulatory perspective, this is extremely powerful. Then the other thing is issuance of cryptocurrency. We think about cryptocurrency as a non-sovereign entity at the moment. We think about Bitcoin and Ether and Dogecoin, etc. But more and more central banks are talking about issuing their own currency onto a blockchain. Now, the Bank of Canada is doing it, Bank of England, Bank of China, Central Bank in South Africa is considering these things. And so if that actually happens, then there's an argument to say that actually people can start banking directly with the central bank. And that commercial banks may be threatened by this. So if you think about the implications of that, that's severe. Because commercial banks right now, central bank says, go ahead, do your work. We don't want to be bogged down. We're interested in monetary policy. We're interested in financial stability of the economy. So do your work, and if people have queries, then they deal with the commercial banks. In this situation, you would have a world where deposit taking could be directly with the central bank, And there is a case to say that potentially the banks of the future may not be depository-taking institutions. I'll pause there. There's lots to say, lots to think about. But I wanted to just give you a little bit of a picture of where we're going. It's going to take many, many years for this to take place. But we're on that journey, and there's no turning back. Thank you so much.